Over 90% of professional fund managers, people with decades of experience and millions in resources, fail to beat one simple investment. An investment you can buy in 5 minutes for almost zero fees. Let's talk about it. Welcome to Fiscal Fluency. Today we're breaking down index funds, what they are, why they beat the pros, and exactly which ones to buy. By the end, you'll know more about investing than most adults. Quick reminder. I'm not a financial advisor, and this isn't financial advice. This is purely educational. Always consult a qualified professional. Let's get fluent. Imagine walking into a grocery store, and instead of picking individual fruits, you grab one basket that has a little of everything. That's an index fund, but for the stock market. An index fund bundles hundreds of stocks together to match a market index. The most popular one is the S&P 500, which tracks the 500 largest companies in America. Apple, Microsoft, Amazon, Google, all in one package. When you buy one share, you own a tiny piece of all 500 companies at once. No researching individual stocks, no picking winners and losers. You just own the market. And historically, the market goes up. The S&P 500 has averaged about 10% annual returns over the last century. Through wars, recessions, and pandemics, it always recovered. Here's the part that surprises everyone. You'd think professional fund managers with Bloomberg terminals and Ivy League degrees would crush a simple index fund. They don't. The SPIVA scorecard tracks this every year. Over a 15-year period, more than 90% of actively managed funds lose to the S&P 500. 9 out of 10 professionals beaten by a fund that runs on autopilot. Why? 2 reasons. First, fees. Active fund managers typically charge 0.5% to 1.5% of your money every year. Index funds charge as little as 0.03%. That sounds like a rounding error, but watch what happens over time. If you invest $10,000 and add $500 a month for 30 years at 10% returns, with an index fund, you'd end up with about $1.13 million. With an actively managed fund charging 1.5%, you'd have roughly $870,000. That's a $260,000 difference, and you got less for paying more. Second, emotion. Professional investors are still human. They panic sell, chase trends, and get overconfident. An index fund doesn't have feelings. It just follows the index. A Warren Buffett made a famous $1 million bet that the S&P 500 would beat a group of hedge funds over 10 years. He won convincingly, so which index fund do you actually buy? For beginners, start with the S and P 500. 2 crowd favorites. VOO from Vanguard, expense ratio 0.03%, FXAIX from Fidelity, expense ratio 0.02%. Both are excellent. You can't go wrong with either. Open a free brokerage account at Vanguard, Fidelity, or Schwab. If your employer offers a 401k with matching, start there. That's free money. Otherwise, a Roth IRA is a great option for tax-free growth. Search the ticker, click buy, and you're done. You now own a piece of 500 of the world's biggest companies. Here's the most important part of this entire video. Set up automatic recurring investments. Most brokerages let you auto-invest weekly or monthly. This is called dollar cost averaging. You buy consistently whether the market is up or down. Over time, this smooths out every bump and builds wealth on autopilot. The biggest risk with index funds isn't picking the wrong one. It's not starting at all. Index funds bundle hundreds of stocks. They beat 90% of the pros. They cost almost nothing, and you can buy one in 5 minutes. The hardest part isn't choosing, it's just getting started. If index funds just clicked for you, subscribe to Fiscal Fluency. With every topic, we translate another piece of the financial world into something you can actually use. Next up, we're breaking down compound interest and why starting at 25 beats, starting at 35. Stay fluent. I'll see you in the next one.